welcome to episode 26 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Surya and I'm coming to you from the beautiful San Francisco Bay Area.
And my name is Thoma Surya and I currently attend the University of California, Los Angeles.
What we will cover in this podcast today is just a small part of what happened in the special situations world last week. For daily updates and alerts on the special situations world, as well as access to tools that will help you identify opportunities such as the merger arbitrage tool, check out insidearbitrage.com.
On today's podcast, we'll discuss Home Depot outbidding Brad Jacobs QXO to acquire GMS, Concentra Biosciences acquiring yet another cash-rich zombie biotech, a potential deal for Verint Systems by Thoma Bravo, the Sears spinoff Land's End receiving competing bids from rival apparel companies, the spinoff of Ralliant from Fortive, a large number of buyback announcements at some of the biggest banks, including JPMorgan, and a whole lot more.
Nothing in this podcast should be regarded as investment advice, and please listen to a full disclaimer at the end of this podcast.
If you've been enjoying this podcast, do us a huge favor and take a moment to like, subscribe, and rate this podcast on whatever platform you may be listening on.
So we started our last episode talking about how Brad Jacobs made another bid for a construction and building products company, GMS, which stands for Gypsum Management and Supply. The very next day, the Wall Street Journal reported that Home Depot had also made a bid for the company, potentially setting the pre-deal situation up for a bidding war.
And then the very day that we released the podcast, Home Depot announced their official bid for the company, which is why we're starting this podcast off with a discussion of newly announced M&A instead of beginning with deals in the works like we typically do. GMS entered into a definitive merger agreement with Home Depot to be acquired by its specialty trade distribution subsidiary, SRS Distribution. Under the terms of the agreement, Home Depot, via SRS, will commence a cash tender offer to purchase all outstanding shares of GMS common stock for $110 per share, for a closing value of $5.5 billion. The transaction is expected to close by the end of Home Depot's current fiscal year, January 31st, 2026.
This $110 deal by Home Depot is well above Brad Jacobs' price of $95.20 for each GMS share, which is already a 27% premium to the 60-day average trading price. The question now becomes one of whether or not Brad Jacobs will step up to the plate with yet another higher offer, or back down and set his sights upon another business. The spread on the GMS Home Depot deal is a mere 0.27% at the moment, and it looks like the market isn't expecting a new offer. Certain news sources have begun to report that Brad Jacobs and QXO have set their eye on another business, which is yet to be revealed. So it looks like they might take this loss in stride and continue on with acquiring other attractive businesses in the building products and overall construction industries.
And it really becomes a question now of what are they going to acquire next? What are some possible targets? And can you get ahead of the potential deal alert in that sense?
And whether they're going to end up overpaying at some point if they end up with competitors like Home Depot or Lowe's stepping in and also trying to roll up this industry. And when they get to a certain point with the roll up, the regulators will probably start taking a closer look as well.
Yeah, so he has this grand plan, but how far and how long it'll work for remains questionable.
Indeed.
Now moving on, less than 2 months after Dick's Sporting Goods decided to acquire Foot Locker in a $2.5 billion deal, we have a much smaller new deal in a similar space with the acquisition of Big 5 Sporting Goods by Worldwide Golf and the private equity firm Capitol Hill Group for a closing value of $113 million.
So this deal is structured as an all-cash deal for $1.45 or $1.45, and the spread on the deal is just 2%. Worldwide Golf, as the name implies, is a golf retailer that sells through the internet as well as through 95 stores across 25 US states. Getting back to the Dick's Sporting Goods deal, director Robert Eddy purchased $500,000 worth of Dick's stock, according to a filing last week. He joined the board of Dick's Sporting Goods in September 2023, but this is his first insider purchase. So it's possible that he's looking at this Foot Locker acquisition very positively, assuming the regulators allow this deal to close.
This week, we saw Concentra Biosciences enter into a merger agreement with IGM Biosciences to be acquired for $82.85 million. Under the terms of the agreement, shareholders of IGM will receive approximately $1.25 in cash per share owned, plus one non-tradable CVR, or contingent value right. The CVR is a bit wordy, so bear with me here. It represents the right to receive 100% of the closing net cash of IGM Biosciences in excess of $82 million, and then 80% of any net proceeds received within 1 year following the closing of any disposition of certain IGM Biosciences product candidates and or intellectual property that occurs within 1 year following closing.
That's quite a mouthful. We normally don't discuss such an incredibly tiny deal, but this deal stood out to us because of the acquirer, Concentra Biosciences. This is the fourth announced deal by Concentra Biosciences in the last 4 months. Almost like clockwork, at the start of every month, they announce the acquisition of a small microcap biotech company. The deal started with the announcement of the acquisition of Allakos for $9 million, then Kronos Bio for a $35 million deal, then Elevation Oncology for $21 million, and IGM as a fourth name on the list.
The name Concentra Biosciences was also very familiar to us, as way back in episode 10, we discussed the acquisition of the biopharma company Acelyrin by another biotech, Alumis, for $191 million. While the deal eventually closed in late May of this year, there were multiple competing bids throughout the entire acquisition, and Concentra Biosciences had actually swooped in for a moment, offering a higher price, though the deal eventually went as planned, with Alumis acquiring Acelyrin at an ever so slightly higher price.
I guess they used all that money that they didn't use to buy Acelyrin to go on this buying spree every month. Concentra Biosciences is a vehicle controlled by Tang Capital Partners, a prominent life sciences investment company led by Kevin Tang. It seems as if Concentra's playbook is to acquire struggling biotechs, many of which we like to call as zombie biotechs, a concept that we've discussed in great detail in previous episodes. But to briefly summarize, zombie biotechs are biotech companies valued at less than the cash on their balance sheet.
IGM Biosciences in particular very recently received written notice from the NASDAQ indicating that the biotech had failed to meet the $50 million minimum market value required to continue trading on the index. The acquisition by Concentra is a lifeline to the company and to investors, as it frees up capital both invested in the company and then also capital locked on the balance sheet of the company that could be used elsewhere. That's why the CVR is structured in a way that returns the net cash from the company to shareholders, as well as the sales of any IP or product candidates. Typically, we see CVR structured as based on achieving different milestones in the drug development process, but Concentra's goal seems to be to sell everything off instead of really trying to develop these product candidates themselves and retain as much capital as possible.
It's possible that maybe Roivant might take a look at some of these products or IP and they might say, hey, just like we've acquired them from large pharma companies and have actually made a lot of money in some of our subsidiary Vants, we could potentially do that as well. It's unlikely they might look at this, but the CVR structure maybe incentivizes management teams saying, if you truly believe that something is going to happen with this IP or this product pipeline, you could get paid down the road for it. So let's make a deal right now, put shareholders out of the misery, return something back to them, and we can see what happens to the product pipeline. Switching gears a little bit, we wanted to kick off the deals in the works section of this podcast with a potential deal for Verint Systems by the software-focused PE firm Thoma Bravo. Last week, Bloomberg reported that Thoma Bravo is negotiating a potential deal for Verint Systems, which makes call center software.
We looked at Verint Systems after this news came out and found that while the company remains profitable, revenue growth has slowed down, and they saw year-over-year declines in revenue in each of the last 2 quarters. This is one of the companies that is at most risk of disruption from AI, as companies increasingly adopt chatbots and AI-powered call center software for their customer service.
In fact, a friend of mine in Silicon Valley founded a healthcare-focused AI call center software company called VoiceCare AI, and they recently raised a $4.5 million seed round of funding. Getting back to Verint and Thoma Bravo, it is worth noting that Verint trades for less than 1.5 times trailing sales and just 11 times EBITDA, which would make it a very attractive target if the buyer believes that the company can transform itself to grab a share of this AI-powered customer service agents segment of the market.
Speaking of Thoma Bravo, they acquired Olo last week, which for a second I thought said Ola, for $2 billion in an all-cash deal for $10.25 per share, representing a premium of about 15% from the stock's last close. Olo makes software especially for restaurants and for online ordering and payment systems. Thoma Bravo paid almost 5 times trailing sales for Olo, but the company was growing revenue by over 20% and was barely profitable.
Another friend of mine also runs a restaurant point-of-sale software company, and his company, Lavu, has been growing like a weed, despite competition from Toast, Bar Technology, and Square. I know you mentioned that when you first saw Olo, you thought it was Ola. That also means hello in Spanish, but it's also the Uber equivalent in India, one of the biggest ride-sharing companies in India. And when I saw that, I thought they were talking about Ola, but turns out to be it's a different company.
Continuing on, way back in episode 16, our main story was a possible bidding war for Guess, which received a $13 takeover offer from the brand management and acquisition firm WHP Global. Rival Authentic Brands, which owns notable brands such as Reebok, Champion, Forever 21, Nautica, and more, was reportedly also considering making a bid for the company that would rival the $13 per share offer from WHP Global.
This week, it looks like the two groups are competing once again. The apparel retailer Land's End attracted interest from both groups this week after initially announcing that they were exploring strategic alternatives in March. While none of the bids have been revealed to the public just yet, this does indicate a broader phenomenon of these serial brand acquirers graduating from acquiring brands out of bankruptcy and now moving on to the next tier of brands that can be acquired. Land's End may not always generate profits, but the company isn't near bankruptcy and is generating pretty stable revenues.
Land's End is actually a spinoff from the struggling retailer Sears, which acquired the company back in 2002, spun it out in 2014, before eventually going bankrupt in 2018. This move to push for strategic alternatives at Land's End was partly due to the billionaire investor Eddie Lampert, who sent a letter to the board advocating for the sale back in February of this year. Mr. Lampert owns about 17 million shares of the company, giving him an ownership stake of more than 53%, which also brings up questions of whether or not the stake will be rolled over or bought out if Authentic Brands or WHP Global is to acquire the company.
I still remember back when Eddie Lampert had merged Sears with Kmart and everybody felt that he was going to be the next Warren Buffett. But instead, Sears ended up losing a lot of money and eventually going bankrupt. I unfortunately had a small stake in Sears and that didn't work out. But when you look at all the different spin-offs that he did along the way, Land's End being one of them, Seritage Properties was another one. Maybe things weren't as dire as they looked by the time the company went bankrupt. Switching to another pre-deal situation, a consortium led by Canada Pension Plan Investment Board, together with Platinum Hawk, Abu Dhabi Future Energy, and Renew Energy CEO Sumant Sinha, submitted a non-binding proposal to acquire Renew Energy Global for $8 per share. This was a 93 cents increase from its prior proposal in December 2024. Renew Energy Global is an interesting company that is incidentally headquartered in London, has operations in India, and now is going to potentially be acquired by the Canadians. It doesn't get more global than that.
They relisted on the Nasdaq in 2021 and currently represent 8% of India's total installed renewable energy capacity. The consortium making a bid for the company already owns more than 58% of the shares outstanding of Renew Energy Global, and the Canadian Pension Plan owns nearly 35% of the stake. The stock currently trades at $7.67 per share.
So investors could make, a little over 30 cents per share if it stays at that $8 level, or if the company holds out for a little bit more, they could get a slightly better return. Speaking of going global, Jumia, which is known to many investors as the Amazon of Africa, has reportedly drawn takeover interests from the telecommunications company Axian Telecom. Axian, which is based in Mauritius and primarily offers telecommunication services in Africa, raised $600 million this week to refinance its debt and help fund a possible takeover of Jumia. No final decisions have been made, and the company may not come to an agreement about the acquisition.
Jumia reminds me a lot of Mercado Libre, which has long been hailed as the Amazon of Latin America, and Coupang, which is known as the Amazon of South Korea. Coupang is a company that I've actually been following for a little bit, especially after we've seen repeated insider purchases at the company by Neil Mehta, one of the VCs at Green Oaks. These companies all have an almost monopoly on the e-commerce and online retail space in their respective countries, which tends to lead to impressive revenue growth and high margins. Jumia is interesting because unlike the other competitors I just mentioned, the company is unprofitable and revenue has declined over the last few years, though net losses are decreasing over time, which is impressive in the context of declining sales.
Yeah, retail is generally a difficult business, whether you think of it as retail with stores or retail with e-commerce. And some might argue that actually it was not until Amazon got into AWS and it started doing things like the Amazon Marketplace and its advertising, did we really start to see the business hum and generate a ton of free cash flow. So the retail side of it is interesting, and you get a lot of early growth, but maybe not the kind of free cash flow that investors are looking for these days. To wrap things up, there was a plethora of active M&A transactions that were consummated last week. The biggest one was a $14 billion acquisition of Juniper Networks by Hewlett Packard Enterprise. The Justice Department settled its lawsuit challenging this deal less than 2 weeks before the trial was set to start. The lawsuit was a big surprise to merger arbitrage-focused investors because it happened after the Trump administration came to power.
Some of the other deals that completed last week that we've discussed on the podcast numerous times include the acquisition of Global Blue by Jared Isaacman's Shift4 Payments, Springworks Therapeutics by Merck, Satisfy Communications by MDA Space, and Redfin by Rocket Companies, though the Mr. Cooper acquisition still remains.
Yeah, I was watching that one to see if they let that go through, considering shortly after the Redfin acquisition, Rocket Companies announced the acquisition of Mr. Cooper. Talking about spinoffs, we had one new spinoff that completed last week. Fortive spun off its precision technology segment, Ralliant. Shareholders received one Ralliant share for each 3 Fortive shares held as of June 16th. Fortive is an industrial technology company, and the Ralliant spin-off will focus on precision instruments and engineered products. They make things like oscilloscopes and semiconductor test systems.
While Ralliant is a large company that generated $2.2 billion in revenue in 2024, it is also seeing sales decline. As you would expect, the stock is down about 7% since the spin-off, with nearly 20% of total shares traded since the spin-off.
Moving on to buybacks, this was truly a bank buyback week. We saw numerous large US banks announce massive buybacks, including JPMorgan announcing a $50 billion buyback program representing 6% of its market cap. Morgan Stanley reauthorizing a share purchase program of up to $20 billion, representing 9% of its market cap, and UBS Group announcing a $2 billion buyback to be purchased during the second half of 2025. Once that buyback is complete, they will do another $2 billion buyback program that would happen over an additional 2-year period.
These large banks have all run up like crazy in the last year or so, which makes the timing of these buybacks very interesting. These mega banks, many of which are bulge bracket investment banks as well, came off of an incredible fiscal 2024. JPM in particular set a record in 2023 for more annual profit than any lender in the history of American banking. And then they broke their own record in 2024 again. Q1 2025 earnings were a bit more muted, still reporting growth, but the uncertain economic outlook created a lens of caution and wariness.
I wonder what caused that uncertain economic outlook. Could it be over 100% tariffs that were then rolled back? But yes, that did create that uncertain economic outlook that you were talking about. Many of these banks are set to report Q2 2025 results in the next week or so, and I'm curious to see if any other banks will announce large buybacks. We'll also have to see how quickly these banks follow through on the buybacks. Citigroup certainly has, as they announced a $20 billion buyback in January, of which nearly $4 billion has already been purchased year to date.
Moving on to the insider section of this podcast, the billionaire who made his money as a co-founder of Facebook and then founded the productivity software company Asana is buying Asana stock once again. Dustin Moskovitz purchased 450,000 shares of the company for $6 million last week.
Yeah, the average price he paid this time was $13 and change, which is a far cry from the $100 he was buying this stock at, a couple of years ago, I think. As we mentioned in our last podcast, 10 months after Asana announced the appointment of Sonali Parekh as their new CFO, they announced a new CEO, Daniel Rogers, will be starting his role at the helm of the company on July 21st.
Andrew Gundlach, and I probably butchered that last name, a director of the Senior Living Facilities REIT, Welltower, purchased around $3 million worth of the company's stock.
When I first noticed that this was a purchase at a company that focuses on senior housing and outpatient medical buildings, I figured it was probably not going to be growing much or was barely profitable. I was wrong on both fronts, and that's why they say don't judge a book by its cover. This company has a market cap of $100 billion, and not only did they grow revenue by 30% last quarter, but it's also a very profitable company.
Funds from operations of $4.50 per share over the last 4 quarters increased 18% year over year. Welltower stock has done very well over the last year, with it being up 43% in the last year and up 192% over the last 5 years.
When I heard about this company, I was curious to see if a new senior living facility that came up near us called Atrium or Atria was run by Welltower, and indeed it was.
Continuing on, in episode 23, we talked a lot about John Paulson, the famous hedge fund manager who initially had a background in special situations at M&A, best known for his bet against risky mortgages in 2006 and onwards, accurately timing the implosion of the housing market and the Great Recession, making more than $15 billion for his firm.
We specifically discussed Mr. Paulson's later investment in gold, something that makes up a vast majority of his portfolio, as provided by his most recent 13F filing. While his initial investments in gold didn't work out well, over the last year, numerous gold companies have seen their stock prices rally, and Mr. Paulson's overall portfolio appears to be strong now.
We point this out because this week we saw Hume Kyle, a director of the gold mining company Nova Gold Resources, purchased 10,000 shares for a total of $41,000. This is quite a small purchase, and again, we wouldn't be highlighting it typically, except for the fact that Nova Gold is Mr. Paulson's 6th largest position in his 13F portfolio, representing about 4.55% of the total portfolio.
Yeah, it's interesting to see both the insider and the hedge fund manager aligned together, especially considering Nova Gold is up about 25% in the last year. That said, as we've seen time and time again, investing in commodities is very risky, especially if you get the cycle wrong. And then investing in mining companies, even when the commodity is going up, can sometimes be quite difficult because these mining companies don't necessarily closely track the movement of the underlying commodity.
We also saw the CEO of the apparel company PVH purchase $1 million worth of stock. PVH was once named Phillips Van Heusen and owned many brands, including their dress shirts company Van Heusen, that they eventually sold off to Authentic Brands in 2021 and another buyer in 2023 to focus on their 2 core brands, Tommy Hilfiger and Calvin Klein.
Yeah, I was surprised to see that. When I thought of PVH, I always thought that they still held Philips Van Heusen, they held Arrow, and all those old legacy brands. But looks like they really pared down their company to focus on two core brands. PVH's stock, like many other apparel retailers, is down 30% in the last year, despite gross margins of almost 59% and a net margin of 4.63%. The company trades at zero point 0.4 times sales, and the Authentic Brands Group connection made us think of comparing it to Land's End, which trades at just 0.27 times sales with a margin of 48% on the gross margin side and just 0.33% net margins. Looking at Guess, which trades at just 0.21 times sales and has a gross margin of 43% and a net margin of 0.47%, it makes me wonder if Authentic Brands will make that higher bid for Guess.
Moving on to the activist section of this podcast, the Wall Street Journal reported earlier this week that the activist investor Starboard Value has built over a 9% stake in TripAdvisor. That stake, valued at approximately $160 million, makes Starboard one of the top shareholders in the company. Shortly after, a regulatory filing by Starboard officially revealed the stake, and the firm announced that it intends to engage with TripAdvisor's management and board regarding opportunities for value creation.
TripAdvisor's stock is relatively flat over the last year, but has run up by 34% in the last week alone after the Starboard stake was disclosed. The company has consistently been growing revenue over the last few years, but the bottom line has been incredibly inconsistent over the last few years and quarters. Activist involvement could be exactly what is needed to get to consistent profits, and Starboard has already stated that they believe the company to be undervalued as is, without any pressure to change.
It's definitely worth considering how TripAdvisor is going to continue to perform in the next few years, especially in the world of AI, where multiple individuals have opted to use AI to plan for their trips instead of TripAdvisor. It does look like the company has already integrated a very basic AI trip planner into its service, but we'll have to see how that continues to develop and what competitors may emerge.
I clearly understand the risk for this company because I have personally transitioned to using AI to maybe come up with a trip plan instead of wading through dozens and dozens of reviews of some place we might want to visit. Switching gears from AI trip planning to, salt of the earth kind of company, the Idaho-based potato company Lamb Weston announced that it has entered into a cooperation agreement with Jana Partners and Continental Grain Company. If you have eaten French fries at a restaurant, it most likely is a Lamb Weston product that you've eaten. Jana Partners is the well-known activist investment firm, and Continental Grain is a global investment firm that focuses on food and agriculture-related businesses.
As part of the agreement, Lamb Weston has agreed to appoint 6 new directors and expand its board of directors from 11 to 13 members. Bradley Alford, the former CEO of Nestle USA, will now serve as the chairman of the board. They will also now have the former CEO of McCormick & Co. on the board of directors. Jana and Continental Grain have been involved with Lamb Weston since October 2024.
Yeah, this is a very impressive board of directors. I don't know what kind of difference they're going to make, but if things are going to improve for this company, it certainly looks like they have the right guidance at the board level at this point. Switching to something else that has been interesting and we've covered multiple times over the last several episodes, Lifeway Foods is back at it again. Edward and Ludmila Smolansky, who represent one side of the family feud against CEO Julie Smolansky. It feels like we're almost always talking about Lifeway Foods on this podcast, a company best known for its product like Kefir, which is in the middle of a hostile bid by the French food products company Danone. Edward and Ludmila Smolansky strongly support this $27 per share bid, while Lifeway Foods currently trades at just $25.54 per share. Whereas Julie Smolansky and the company's board are strongly against this Danone's offer.
This week, Edward and Ludmila, who together own 23.2% of Lifeway, initiated a process to remove Lifeway's current board of directors and elect a new slate of nominees. The duo are now seeking shareholder approval on 4 proposals: to repeal any bylaw amendments adopted after March 24, 2023, to remove all current directors, including the CEO and chair, Julie Spilonsky, to elect a new board of 7 nominees, and to amend Lifeway's bylaws to prohibit it from employing or engaging any immediate family member of its president or CEO. And do note that Julie Spilonsky, the CEO, happens to be Edward's sister and Ludmila's daughter. So that last family clause is really interesting. This truly is the saga that never quite seems to end.
Switching over to C-suite transitions, we wanted to briefly cover a few C-suite transitions from the prior week, including Krispy Kreme announcing a new CFO. The company's current president of international operations, Raphael Duvivier, will take over the role of CFO next week, replacing Jeremiah Ashukian, who left the company to take a job at an undisclosed private company.
Krispy Kreme has very much been struggling recently. The stock is down about 67% in the last year, and in May, Krispy Kreme announced that they were pausing their quarterly dividend for more financial flexibility amid declining sales.
The company also mutually ended its partnership with McDonald's as Krispy Kreme said it was unable to scale the collaboration to more US locations profitably.
This C-suite transition at Krispy Kreme adds to another change from last week, where the Chief Product Officer, Allison Holder, became the Chief Brand and Product Officer of the company, replacing the departing Chief Growth Officer, David Skenna.
That's quite a few changes. Let's switch gears to a biotech company. Imagine a company that has grown its revenue more than 8-fold over the last decade, from just $511 million in 2014 to $4.24 billion in 2024. Imagine that it expects to generate another $3 billion in sales from a blockbuster drug this year, has multiple additional FDA-approved drugs that are generating sales, expects 10 new product launches by 2030, and has a stock price that is 35% below where it was 10 years ago. That company is Insight, and it appointed Bill Murray as its new CEO last month, following the same day departure of its prior CEO, Herb Hoppenot. The company has a market cap of $13 billion and has about $2.8 billion of net cash on its balance sheet, and has repurchased 13% of its shares outstanding over the last 4 quarters.
Insight is a biotech company that focuses on drug discovery related to oncology, inflammation, and autoimmunity. Its lead drug, Jakafi, treats diseases like bone marrow and blood cancer, as well as graft versus host disease, where the immune system attacks the body after a stem cell transplant.
Jakafi generated $2.8 billion in sales for Insight in 2024. Novartis, which sells Jakafi outside the US, and just to make things confusing for all of us, decides to call the product Jakavi, generated $1.94 billion of sales in 2024.
Bill Murray has a long history of being associated with biotech companies that get acquired, including Forest Laboratories, Karuna Therapeutics, and Anthos Therapeutics. It is possible that he might use Insight's strong balance sheet to acquire companies in a beaten-down biotech sector, or set Insight up for a sale like he did at both Karuna and Anthos.
Indeed, that'll be interesting to see, and this was a spotlight idea in our last Special Situations newsletter. To wrap things up for this episode, it is worth mentioning that Ulta Beauty's Chief Financial Officer, Paula Ayibo, resigned suddenly. In fact, the departure was announced a day after she had already left the company.
And that wraps up episode 26 of the Special Situations Report. What we've covered today is just a brief overview of the special situations landscape, so if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com.
If you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.
We also wanted to provide a reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.